Today we are discussing Extra Space Storage Incorporated, ticker EXR. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. First up, the market cap is $20.7 billion, enterprise value of $27 billion. So you can be about $6 to $7 billion in net debt on this business. That's quite a bit of leverage. You're talking about 20% of the overall enterprise value functioning as debt. This is an equity real estate investment trust or a REIT, so it's not uncommon that you'd be heavily leveraged for a company like this. So they're headquartered in Salt Lake City, Utah, self-administered, self-managed REIT, member of S&P 500. They have 1,906 self-storage stores in 40 states, 1.4 million units. So it gives you an idea of how large they are. They're the second largest owner or operator of self-storage stores in the United States, and the largest self-storage management company in the United States. Gives you some idea, quite large business. They have a beta of 0.54. That's about half of the average volatility of an S&P 500 company. The lower that is, tends to be a better investment, better stock. One potential sign of a high quality business. Now, self-storage in particular is an interesting area of the real estate market that I've been interested in for some time. So I'm interested to dive into this data, see what we can see about the returns on invested capital. There's a few things that leap out about this chart immediately. First is that you have 4 years of losses from 2002 to 2005, but every year since then you have been profitable. That's a good sign because this looks a little bit like almost like startup expenses struggling. It could be struggle during the recession of 2002, 2003. Kind of hard to tell. But clearly they have improved steadily since then. And that's the second piece I can see, is you've seen pretty steady improvement since 2005. They turned a profit in 2006 at 1% return on invested capital. 1%, 1%, 1%, 1%. They reached 2% in 2011, 4% in 2012. They continue at 4%, 4%, 3% in 2015, 5, 6, 5, 5, 5, and 8. So basically, you've seen pretty slow and steady improvement on the return on invested capital over time. This is in contrast to many REITs that I have studied in the S&P 500. You don't see a lot of this steady improvement. In fact, you see a lot of them capped at the 2, 3, 4% return on invested capital. This one not only is above 5%, but has started to reach 8% in the most recent year, and that's a really good sign for their potential in the future. If you see this trend continuing, then you can make a really good case for a strong investment case for this company. And one of the things that is critical about that is when you get down to this key statistics number, you can see that they have averaged that 5% return on invested capital, but with their debt, they've been able to leverage that into a 14.7% return on equity. This is good because a lot of the REITs I see, you have a number of 2 to 3, maybe 4% return on invested capital, and then they can't get return on equity into the double digits. I really need double-digit returns for my investments, and so you need a return on equity in the double digits. And I'm targeting a return on equity of 15% plus. 14.7% is approximately 15%, so I would say that this meets my threshold, especially when you consider that in recent years it's been getting better and better. In 2021, they hit an 8% return on invested capital. These return on equity numbers could trend towards the 20% range if these return on invested capital numbers start creeping up towards 10%. Very strong setup there. All of the margins here are very good. 72% gross margins are amazing. And they're translating that into a lot of free cash flow. 53% free cash flow margins, 47% EBIT margins. A lot of times I've studied companies where you have a 72% gross profit margin and they don't get above 20% on free cash flow or 20% on EBIT. Somewhere in the 10% range is still pretty good. So these are very strong margins on the back of pretty good returns on equity. So far, this is looking like quite a high quality company. In particular, the stability, the year-to-year stability is incredible, and that is very, very helpful for predicting the long-term future of this business. Now, you are paying a relatively high price. PE of 22 is above average in terms of the overall price structure. Price to book of 5.1 tells you that you're not exactly cheap, and price to sales 11.2 certainly confirms that you're not at a cheap price. I would like to get this company at a cheaper price. It is difficult to get cheap prices on REITs, but there is a reason it's trading at this rate, and it's because of their growth. They've been growing their revenue at 16.9%, assets 15.3%, free cash flow and EPS both above 20%. When you see these sorts of growth rates, especially in an S&P 500 company, you're highly unlikely to get a cheap valuation. It does mean when you find a cheap valuation, it's even more exciting, but I'm not surprised that you're above 20 on the PE ratio. Now, I like to buy a stock of a PE of 15 or less. That's really my cap point. But for a high quality business like this with these sort of growth metrics, if you can just get it at 20 PE, you're probably in a really good range for good future returns. So that doesn't require much decline from here. You're talking 10 to 20% lower prices, which, maybe $130 a share, $120 a share. It starts to get a little bit interesting. Of course, I'd like it at the PE of 15. But with these metrics, I'm going to find it very hard to believe that you're going to get that in any sort of reliable year. And one of the reasons for this is you can see how the revenue growth is being translated into operating growth on the bottom line, and it's due to operating leverage. You have revenue growth, of course, averaging this 16% range, and yet you have your gross margins here of 70%. They've grown the gross margins from 70% to 74%. Here's that growth, but they've taken the operating margin from 39.7% to 52%. That's a 12 to 13% growth in the operating margin on only a 4% growth in the gross margin. That's your operating leverage, and that's what's driving this extra 10% return from 16.9% revenue growth to 27.6% growth. Anytime you have operating leverage in a business, which means that your earnings are growing faster than your revenue, now that can't be sustained forever, but it really is a way to supercharge your returns. So you like to see that as a shareholder. It's why their operating profit's gone from $163 million to $835 million. You've more than 4x'd. You've basically 5x'd your operating profit in a decade. Anytime you hit that metric, you're in a very good spot. Again, they've less than tripled their revenue from $409 million to about $1.6 billion. So about a triple, or maybe not less than triple. They've about 4x their revenue, but they've 5x their operating profit. And that variation makes a huge difference in your long-term compounding. Likewise, your EPS has gone from $1.14 to $6.19. So again, you've more than 5x your EPS. That's even better. It does suggest that perhaps there is some shares outstanding being bought back over time. I'm going to have to dive deeper into that when I get to the income statement, but I really like to see that. What's even more impressive is that they've done this with dividends per share continuing to be paid out as a significant part of the earnings. Now, that's not uncommon. REITs are required to pay out 90% of their earnings, so you're going to have that. But it does mean that likely some of this growth is being paid for through dilution and additional debt. We're going to have to take that into account. But you can just see when this really tipped into a very, very good investment, and it's when you went from these return on assets of the 3 or 4% range to hit the 5 to 6% range, and that's when you were able to take your return on equity from the 8 or 9 up into the double digits. All of that is really impressive, and you can already see how an 8.3% return on invested capital is translating into a 24% return on equity. So you start continuing out these 2021 numbers, and you start to get very, very attractive potential returns to you as a shareholder. If you're enjoying this video, if you like it, please hit that like button. Don't forget to subscribe. I'm covering every company in the S&P 500. And at the end of this video, I have a link to the watch list stocks that are my favorite companies I have covered in the S&P 500. So the income statement, let's see what else we can figure out. So you've doubled your SG&A. This is part of why you've had some operating leverage. You're able to 4 or 5x your gross profit, but you only doubled your SG&A. That's going to lead to growth on the operating profit line. Likewise, your other operating expenses aren't growing as fast as your gross profit. That's giving you some of that leverage. You really like leverage in a business like this. And you can see also that they've been able to keep their net interest income pretty low. Now, as interest rates go up, that's going to change a little bit. But you can see that they only doubled their net interest income, even though they, 5 or 6x their operating profit. That's a lot of incremental return to you on the bottom line of a shareholder. Now, what's impressive is they have diluted you as a shareholder by 30%, 35%. You've gone from 104 million shares outstanding to 140 million shares outstanding. And a 35% dilution over the course of a decade is going to be about a 3% per year reduction in the overall CAGR to EPS. So think about that. You've reduced your EPS CAGR by 3% per year, and yet you've still hit a 27% margin. So that's the difference between 30% growth and 27% growth, which doesn't really matter. It's times when you're growing at that rate that dilution can make a lot of sense because your growth is so valuable that even on a diluted basis, you're growing your EPS so much. A lot of the REITs I've looked at, they're going to have similar dilution, and yet the dilution is not going to be low compared to the overall growth in the business. The dilution is actually worse than the overall growth of the business, and it really harms shareholders. In this case, it looks like the dilution has added a lot of value because they've been able to execute on their growth plan and lead to a lot of operating leverage for shareholders. So this would be the rare case where I'm not only okay with the dilution that I've seen, but it's not going to necessarily stop me from being interested in the stock because the business is being so well managed. Now, there is this continuous jump here from 2020 to 2021. You have some concern that COVID has impacted this a little bit, going from a 482 million to 828 million. So you need to understand, is this recent growth in earnings per share sustainable? If it's not, that could be a concern going forward. But if it is, then you could really see an acceleration in the business. So we like to see that. Balance sheet. Okay, anything interesting here? I want to see debt. So we've taken our debt up 4x, 1.1 billion to 5, maybe 5x. You 5x your debt, 5x the EPS, that's okay. PP&E is low. I think it's because they're counting their real estate under this asset base. So you 4 extra assets, 4 extra revenue, makes sense. Nothing concerning there. You have some investments. If these are like equity investments, then that's kind of an extra bonus for you as a shareholder, but you'd have to dive a little bit deeper into that. Retained earnings. So this is what's interesting, right? So they're growing almost entirely with the use of debt. They're not having to, all their earnings are being sent back to shareholders. I think we're going to see that when we get to the cash flow statement, that you're able to not have to retain earnings in the business. They've been making a lot of money, but they've been able to send that money out and still grow. That's very, very impressive. So let's look at the cash flow statement. So you see that there's a lot of investments here. And this tells you a lot about why they're having to dilute and why they're having to raise debt. So, see in 2012, they had 200 million in cash flow from operations, and yet they made 600 million in investments, presumably in real estate. So that extra 400 million has to come from somewhere, and you see 430 million from net issuance of stock, right? So, and here you have a gap of 271 to 359. You need to cover that with about 150 million, and they issued both 160 million of debt. They had some stock here that was used to cover, of course, paying the dividend as well. Likewise, you have just this continuing gap as they buy more real estate than the cash flow from operations can support. Now, that's not a great setup, but when you're getting such high returns off your real estate, then you can sustain that. A lot of these that I look at, it's just not sustainable. But because of the high returns they're getting in this segment of the real estate marketplace, they're able to make this work. Normally, I don't like the fact that I'm paying out more dividends than my net income. But again, with REITs, you're going to be paying out a large amount, and you're going to have to bring on extra financing in order to grow. They're doing that through debt. They're doing that through stock. And because of the high returns they're getting, it's worth it. It makes sense for shareholders. So this would be a REIT that would go on my watch list because they're able to maintain these high metrics. Let's go over some of the keys here. You have high and growing and sustainable returns on invested capital. Not just stable, but they're stable. And so the fact that they're stable and improving is really good sign for the future. You're hitting a double-digit return on equity, and you're right around my 15% target over the last 10 years. And the most recent year has already pushed above 15%. Going forward, that's a very strong sign. You're growing at strong double-digit rates, above 15% on revenue, and in the 20% plus for EPS. The fact that there's operating leverage there is even more exciting, and the fact that you're able to do this with really high margins means there's potentially a little bit more that you can eke out in terms of operating leverage. Now, I wouldn't bet on this sort of growth over the next decade, but just getting in the double digits, 10 to 15%, would be very, very attractive to you as a shareholder. Now, the PE ratio is a little high, but that doesn't stop me from putting this on my watch list because there's always a good time where you might be able to buy a stock like this when it has such amazing growth rates. It's operating as a high-quality business, and management is finding such attractive opportunities to invest in. I don't have a problem with the use of the debt and equity to make those investments because of the high returns that they are getting off of that work. So if you enjoyed this video, hit the like button, please subscribe, and check out the playlist at the top here of my favorite companies in the S&P 500. These are my watch list stocks, just like the one you saw today. You will find some great companies in there to check out. Also, consider joining quickfs.net. This is the software I am using. My affiliate link is the first link in the description below, and you can support the channel by signing up for a free or paid account through that affiliate link. Thank you for listening, and until next time, stop paying fees, start building wealth.